incorrect choices. Some consequences here, and because the status quo bias is not a matter of conscious choice, one of the consequences here is unknowingly maintain portfolios within appropriate risk characteristics. Status quo appeals to an individual's sense of laziness, you fail to explore other opportunities. Let's look at detection and guidance, and this should catch you off guard at first. Education is essential. Now, we said this for cognitive biases, but this is listed under an emotional bias, and we said that they are best adapted to. So what are we doing with educating? Status quo is more of as I said earlier, appealing to somebody's sense of laziness, of not wanting to do anything. It's easier to do nothing and just say, you know what, everything's good enough. It's not really an emotion. It's more of a disposition. So education here can be helpful. Quantifying the risk-reducing and return-enhancing advantages of proper diversification and proper asset allocation. And, of course, that's the job of the financial advisor. Endowment bias. People value an asset more when they own it versus when they do not own it. When you and this is generally true of most people. When you look at when they decide that they want to sell something that they own, they tend to ask a price for it at which, if they were the buyer, they would never pay. That if they were going out to buy the very thing they were selling, they would never pay the price that they're asking for it. Ownership tends to endow the asset with added value. Consequences here: fail to sell certain assets simply because you're not going to get the price you want for it, so you say, well, I'm not going to sell it. Fail to sell certain assets and replace them with others, and continue to hold classes of assets with which they are familiar. The thought here is that they may believe they understand the characteristics of investments that they own better than those that they do not own. Consequences: may maintain an inappropriate asset allocation. Detection and guidance: reframe the problem. If framing is, if we are susceptible to the framing bias, well, we can use that as well. Ask, would you buy the current portfolio at your asking price? Or if we had inherited some assets, or if a client had inherited assets and they feel a sense of familial attachment to it, ask them, if you had cash instead, if you had inherited cash instead, would you buy the same assets as was given to you? Regret aversion bias. People tend to avoid making decisions that will result in an outcome out of fear that the decision will turn out poorly. And there are two types here: an error of omission and an error of commission. Error of omission: we regret an action not taken. So we're holding a security. We should sell the security, but again, we want to avoid making decisions that will result in an outcome. What if it goes up? What if I sell it and it goes up another 20%, 30%? I certainly don't want to do that. And so we don't take the action, and it drops in price, and now we regret not taking the action. We should have taken the action, we didn't. Error of commission is regret from an action taken. The market is plunging, your stock is dropping. You don't want to see it drop anymore. You decide that you're just going to sell everything, you can't take it anymore, and then the market recovers, as it always does, and leaves you behind with losses that are going to be very difficult to recover. There's some regret there. Consequences: you end up being too conservative in investment choices as a result of past poor outcomes, and investment choices that are too conservative can lead to long-term underperformance. Consequences here: engage in herding behavior, so you stay with what is popular. Choosing stocks of less familiar companies may be perceived as riskier. Detection and guidance: quantify the risk-reducing and return-enhancing advantages of diversification and proper asset allocation. Sounds like education going on here, even though this is an emotional bias. Recognize that losses happen to everyone, and this is true. If you're not comfortable with losses, buy government bonds of developed countries. And even there, with the amount of debt we have mounting across the globe these days, I don't even know if that's completely safe. But losses will happen to everyone. No one in the history of this game, no one has a 100% record. Greatest investor ever, Warren Buffett, he's taken losses, but he knows when to take losses. Take losses when they're small and when you realize that you have a problem. LOSC. Describe how behavioral biases of investors can lead to market characteristics that may not be explained by traditional finance. And what is not explained by traditional finance is referred to as an anomaly. It doesn't fit with our theory. It must be an anomaly. But we do find that over time, as we develop better traditional theories, anomalies can be explained. An anomaly is a deviation from market efficiency. If we have a hypothesis that markets are efficient and we accept that, then any inefficiency, well, that's odd. That shouldn't happen. We need to explain why there is an inefficiency. And if we can't explain why, we have an anomaly. Behavioral finance steps in and says, oh, we can explain that because traditional finance doesn't include psychology. We have that. A market anomaly to be an anomaly, should provide persistent abnormal returns that differ from zero and are predictable in nature. So that sits outside of efficiency. And this anomaly should not be attributable to the choice of asset pricing model. As an example, let's look at CAPM. CAPM has one single beta, and that is a sensitivity to the market factor. If we use a three-factor model, which has sensitivity to the market factor, sensitivity to size of the company, and sensitivity to the value or growth dimension, we find that an anomaly, a previous anomaly, using this asset pricing model, CAPM, could not explain the premium for small cap stocks. How are small cap stocks providing a higher risk-adjusted return versus growth stocks on a persistent basis? There's something wrong here. But once we account for a factor exposure, once we have a better asset pricing model, the anomaly disappears. So the anomaly is not attributable to our choice of asset pricing models, to statistical issues. Small samples can, we can find a lot of significant things in small samples because, well, they're small. And data mining, you can come up with a lot of spurious relationships in data mining, which is why we need to see persistent abnormal returns. And temporary disequilibria. Any market sell-off, good stocks are going to sell off well below their intrinsic value, well below their fundamental value. So very experienced investors always step in and buy in instances like that, and they end up doing quite well. Well, that's just temporary. It's not persistent abnormal returns. It's a temporary abnormal return based on everyone else's fear that they're selling. All right, let's look at some anomalies here. First one here is momentum. Before I jump into this, behavioral finance claims to be able to say, look, we have some explanation or some partial explanation or some part of this bias helps explain things. So for momentum, we're going to talk about availability and hindsight and the belief of how availability and hindsight is playing a role. It is not making a statement saying, aha, it's all availability. It's saying, look, you have to consider the role of these biases, and the most salient ones for momentum would be availability and hindsight. When we get to bubbles and crashes, there are three that are identified down here. If you are uncomfortable with the explanations behind them, saying, well, it seems kind of a weak argument, I'm with you on that. For a lot of these biases, if you give me a problem and you give me enough time, I can make the case, however wispy thin, I can still make the case that it is almost any of the biases. Because we all have emotions, so it must be all the emotions going on at that particular time. This is, when I was doing my PhD, we had a seminar on behavioral finance, and I was just uncomfortable with it as we went through. And we didn't just go through 15. There are literally hundreds of biases because every author has to have a paper and something new, unique, so they name a new one. And it just seemed to never end, and every problem had 53 explanations for it. Well, come on. It became a little overwhelming at times because it was like, look, if you give me a problem set, I can come up with a whole bunch of biases if I have enough words. If I have the time and enough words that I can use, I can make the case that it's almost anything. So if you're feeling uncomfortable about some of the explanations and you think, but it could also be this and it could also be that, yeah, I'm with you on that. Okay, let's see if we can. We'll do our best to make the case for each of these here. Momentum, also referred to as a trending effect. Future price behavior correlates with that of the recent past and typically lasts for up to 2 years before showing a reversal. And if you watch the 52-week high and low list from week to week, you'll find that stocks that make 52-week highs tend to go on to make more 52-week highs, and stocks that hit 52-week lows tend to go on and make more 52-week lows. Momentum is not just in one direction. Momentum means a price a price at one point in time that correlates with the last price. So if we look week over week and we see the price of something is up, and the week before the price was up, and the week before the price was up, that's positive serial correlation. So they are correlated. There's a serial correlation that's positive. Same with negative. If we look and see a stock price down, and the week before it was down, and the week before it was down, well, that's momentum. It's just negative momentum, or momentum to the downside, I should say. One of the behavioral causes here, availability bias. The reasoning is based on recent experience, or the recency effect, that if prices have been rising, expectations begin to rise of future increases. And hindsight bias. We want to reduce the regret of missing out by buying past winners, which is a momentum strategy. A clear momentum strategy is to watch the 52-week high list, and when you see a stock repeat a 52-week high a number of times within a certain span of time, you simply just buy it. And when you see stocks hitting 52-week lows for a period of time, you short that stock. Bubbles and crashes. Overconfidence. Overconfidence shows up in things like overtrading, the underestimation of risk. Certainly for bubbles, you have the underestimation of risk. Failure to diversify. Rejection of contradictory information, that no matter how overvalued something is, you just say, well, prices are going up. So the mantra here in bubbles is, buy high, sell even higher. So what happens is, before I show what happens, we'll combine it with a few other ones here. Confirmation and self-attribution. Selling winners confirms the success of their strategy. And then we have regret aversion, the fear of missing out. Bubbles usually form out of momentum. You'll have momentum that crescendos into a bubble. With momentum, there's a certain momentum trading crowd, and there are momentum traders that trade a particular name or a particular strategy. Sometimes a single name will begin to gain more and more exposure because of its price movement. Then more and more people start talking about it. Then more and more people start getting into it, which pushes the price even higher. And pretty soon everybody's talking about it. So you'll recall GameStop in early January of 2021. Everybody was talking about it, and that's went from momentum to a bubble. So what happens is the stock goes up, and you sell it, and it retreats, and you buy it, and it goes up to make a new high. You sell it, it retreats, you buy it, it goes up to make a new high. And this is it. Selling winners confirms the success of the strategy, and you say, that's what I'm going to do. I'm going to wait for it to go up. I'll sell it. When it retreats again, I'll buy it until when the bubble crashes, until it's over. And everyone who bought it saying, hang on, it's not turning around, it's not turning around. And then you have all the sell orders, which causes the crash. So to dovetail with the last point I made on that screen, we have anchoring. Early stages of the crash. Pullbacks are still seen as opportunities to continue to add. Investors eventually capitulate when the losses become too large. So momentum and bubbles are great for buying the dips on. And most, when it gets late into a bubble, mostly what you have left are rookie traders. And they'll keep buying the dip, even the last one. But they are weak hands. When we say weak hands, they tend to fold very quickly. It's sort of a poker term. So that when the losses get too great, they tend to jump out very quickly. Well, you have a whole bunch of weak hands exiting the trade at the same time, and that's what causes the crash. Then we have value. It's been noted over time that value tends to outperform growth. And there have been some traditional finance reasons given and some behavioral finance reasons given. The behavioral one sounds very much like a traditional finance argument. And rather than, and it's a unique approach taken, saying, listen, we're not going to explain why value outperforms growth. Instead, we're going to explain why growth would tend to underperform value, which is just the same argument, right? So value stocks tend to have low PE multiples, high book value to market value and low price to dividend, so very high dividend yields. And typically very high dividend yields, 9%, 10%, 11, 12, and higher, tend to be a warning sign that the dividend is unsustainable. The behavioral finance effect is something referred to as the halo effect, extending a favorable evaluation of one characteristic to another. So if we think about a growth stock, and that growth stocks tend to perform well, that they tend to go up, growth stocks would tend to be bid up in price, so that when you bought a growth stock, a lot of the future potential of the stock is already in the price. So there isn't that much upside left because everything is priced in. So growth stocks tend to be priced to the point where the expected return in the future is very, very low because all of it is in the price. And if that company stumbles just a bit, that price can drop quite considerably. So you can take a growth stock with a PE multiple of 50, and if it misses earnings just a bit, it might drop to a PE of 35, still considered a growth stock by its PE multiple, but showing a negative return. So over a large group of growth stocks, because they sell off very quickly when growth stumbles, the return tends to be low. So rather than doing a long fundamental approach on growth stocks to determine their intrinsic value, it's just saying all growth stocks have tended to do well in the past. This is classified as a growth stock. I'm going to buy it. I'm extending a favorable evaluation of one characteristic, its high PE, to another, that it being a good investment because it's valued so highly. So a good an example of this is a company with a good growth record means that it is a good investment. Without looking at the price to determine, well, hang on a second now, is growth for way too many years at way too high a price already priced in? If it is, growth can stumble just a bit and you'll get punished. This potentially leads growth stocks to be overvalued. So if we're buying growth and we tend to buy overvalued stocks, they would tend to underperform value because value by definition means we're buying undervalued stocks. That wraps it up.